So in today's video, we're going to talk about reverse mortgages and DSCR loans and all the things you need to know about if you're going to use these properly. All right, so today we brought back Kathy McAlpine, my favorite lender over at Mason-McDuffie Mortgage, and we've been having conversations offline here for a while talking about some of the content and videos we see online, and we keep seeing the term DSCR loan pop up. And I know in these videos, they make it sound like, oh, you just get this loan, it's a slam dunk, and off you go buying rental and investment property or multifamily units, and it's not quite that easy. So I wanted to bring Kathy on today to kind of tell you what a DSCR loan is. And of course, then we're going to ask you a bunch of questions about that. So why don't you tell them what it actually is or what the words even mean?
I know, we have lots of acronyms,
Yes.
but DSCR stands for Debt Service Coverage Ratio. What that means is that the lender is actually analyzing what your income is on the property, because this is for investors purchasing. So just the income on the property that services that debt for qualification.
So if I'm calling you about getting a DSCR loan, are you pulling, let's say, my personal credit?
Yes, we will pull your credit because there are minimum credit score requirements.
Okay, so what would the minimum credit score be for one of these type of loans?
Some lenders will do under 660, so
Okay.
620 I've seen, 660 is probably a little bit more common.
And so I always go to why does the lender care if we're basing the loan off of the income of this particular property?
Well, because the lender still wants to make sure that you're willing to pay that debt back. And that's what your credit score shows.
Okay, so let's say we go out, we find a property, let's say it's a 4-unit property, that's going to be $800,000. Do they have minimum down payment requirements?
You're going to at least need to come in with probably 25% down.
Okay.
But you also have to make sure that the ratio of that income to that debt, your monthly payment, is high enough. And that's really where your down payment comes into play.
Okay, so let's say like we use this $800,000 property, we put our 25% down, so now we have a loan of $600,000. And they're saying that if I say these other, let's say I live in one of the units and I rent out the other 3, do they need those other 3 units, the total income coming from them? Because again, it's just a projection at this point. We don't even have a renter in there.
Right.
Does that 3 other units need to be enough to offset this payment?
Yes.
And so they want it off just those other 3 units.
Yes, off those other 3 units, and it can offset 1-to-1. Some of them will let you go 0.75% to the actual rent. So
Okay.
the higher your offset is, so the more income you have, the better your interest rate is.
Obviously, if we're doing this, you and I are working together doing this, I'm just giving them what I think it's going to rent for. Like, how much documentation are they looking for? Are they looking for potentially even pre-signed lease agreements? Like, how much detail do they want for this other than me projecting, I'm going to rent these out for $1,000 a unit?
Right. They'll do a rental survey on the property. So when they order the appraisal to determine the value of the property, the appraiser is going to do a survey on like rents for that particular property in the area.
Okay.
That's one method that they're going to verify. And then if there are currently rents on the property, they'll look at that as well. And sometimes they'll take the lower of the 2.
Okay, so the question then I get sometimes for clients is this: when would I want to use this loan? So for example, instead of just putting 20 or 25% down on a regular conventional loan that's what I typically use when I buy single family homes versus using this, would they allow you to use this for a single family home too?
Yes.
Okay.
Yes, you don't have to have multi-unit. It can be a single family rental, but not a primary residence.
Okay.
It's always an investment property.
And when people are coming to talk to you about this, would you say, which direction would you tell someone to go, I guess, based upon what they're telling you?
Depends on how much documentation they want to provide, and it depends on whether or not they have other rental properties and maybe they're trying to do a refinance, because you can use it as a refinance as well. If they're writing off a lot of expenses on their tax return for their rental properties, then this would be a great option for them.
So if someone is trying to figure out, hey, I don't own any rental property, and they're wanting to get into the investment game, whether it's single family homes, whether it's multifamily. Again, like I tell people all the time, sometimes it's better to do it in other communities than where you and I live, because you can find less expensive housing in other parts of the country. If they come in and meet with you, how do they decide which direction they should go with this?
We just look at what their options are, look at what their expenses are, what kind of reserves they have. If they're brand new in the investment realm, then definitely look at whether or not they have reserve funds.
Okay.
So sometimes the interest rates on DSCR loans can be really competitive too. So
Okay.
that might be a good option for them.
Okay. So it's really just kind of looking at their whole picture. Is there a lot of personal documentation? I know, like if I go out and buy a primary residence, there are certain things you need for me. Is it the same, or how different is it when I'm buying investment property versus I'm going out and buying a personal residence?
Well, if you do the DSCR loan, it's very limited documentation.
Okay.
So that would be a reason that somebody might choose to do this loan. They don't want to have to show their tax returns. They just want to be able to prove it by the rents on the property.
So this might be good for people that are either self-employed or own their own business. They're not the normal W-2, get a paycheck every 2 weeks kind of people.
Exactly.
Which I know for some people it gets more challenging to qualify because obviously they're always trying to figure out ways to show some income but not too much income, because of course then they got to pay tax and all that kind of stuff. So
Exactly.
Okay, so if you're looking for information about this, obviously reach out to us. I can put you in touch with Kathy. She can get you some information on that. Then there's a second loan that we wanted to talk about that is something like, these are things that are a little more rare, but they've been coming up more and more now. As I'm watching, as me in my 50s and my clients are getting older, these are questions that come up more, which are reverse mortgages. And I know I've seen some horror stories about reverse mortgages. I've seen some people that do them well. But initially, let's just explain to somebody what exactly is a reverse mortgage and what's kind of the purpose of them.
Well, the purpose of a reverse mortgage is primarily for retirees, or you don't even have to be retired, but individuals that are 62 years or older.
Okay.
And it's a way to access liquidity in the equity of their home. And they can use that liquidity for lots of different purposes. Some people, like I had clients that purchase real estate using a reverse mortgage, and they do that so that they don't have to have a monthly payment. So the equity in the property that they've established by putting a large down payment down is what basically paying that interest cost for them.
First question would be, do both people have to be, like if you and I owned a home together, do we both have to be 62 and over?
No, but if it's a spouse and you're residing in the home, then they call it a non-borrowing spouse. They don't have to be 62 or over, but they wouldn't be on the loan, but they could still have rights to live in that property. One of the things about a reverse mortgage that's different than just a traditional, what we call forward mortgage,
right,
is that in order to be eligible for a reverse mortgage, you've got to reside in the property. So it's really utilized a lot for people that want to age in place. So, I think about this too. What's going to happen when I get old enough that, either I want to supplement my retirement, or do I want to go into a home? It's very expensive to go into a home. So maybe you want to utilize your equity in your property to help support paying somebody to come to you and stay in your home.
Okay, so I know for me, and I've done this for years, like the theory behind what a reverse mortgage and how it works, I totally understand that. So let's give somebody like a real life example. Again, let's go back to this whole, I own a $600,000 house free and clear, and I reach out to you and say, hey, Kathy, I'd like to get some access to some of my equity, because I know if people are listening to a lot of the videos we're putting out there, ideally by the time in your 60s, hopefully you own your home free and clear and you don't have a loan anymore and you did all the right things that you should be doing.
Right.
And like you said, a lot of times that's a big chunk of people's net worth, but it's money that you have a hard time getting to, and that's the whole purpose of the whole reverse mortgage. But if I called you and said, okay, I want to do a reverse mortgage, is the documentation, like, is it same as when I do other mortgages? And then a lot of times I've seen some horror stories about this, like what are the costs involved in doing a reverse mortgage?
Right. So reverse mortgage is a little bit different because, again, you're not just getting funds to purchase the property. You're not making a monthly payment in some cases. You can. Some people don't realize that you can take out a reverse mortgage and still make a payment and keep equity to you available in the future. We do verify now that you have the ability to pay your normal obligations on the house. So you have to have enough sufficient cash flow to pay for your property taxes, your homeowner's insurance. And in the past, they didn't do that.
Okay.
So a lot of people got themselves into a pickle because they couldn't afford it and they couldn't sustain it. They'd get a chunk of money out of their equity, but then they couldn't afford to continue to live in that home because they didn't have cash monthly.
So is it typically that they're doing, like, so again, we'll go back to the $600,000 house example. Am I getting a chunk sum of like $300,000? In my brain, I almost looked at it as a reverse mortgage, and now I get a check every month in the mail for $2,000. Of course, I'm being charged interest and things on that, and my balance eventually will get bigger. So if someday the next person inherits the house, which we can talk about in a minute, it just sort of builds the loan balance back up. Or most people taking like a big lump chunk of money.
A little bit of all of that, because you can either take a chunk of money up front, so you can take cash out.
Okay.
You can leave a little bit to have as a line of credit for the future, or you can pull income out of it on a monthly basis for your lifetime or just for a specific period of time. Or you could do a combination of all of that.
Okay.
So it's really flexible to whatever their need is. So you sit down with, a mortgage lender that's experienced in reverse mortgages, but but you also have counseling that you have to do. So there's mandatory counseling that as a borrower you have to go through.
Wow.
Yeah, so it's changed a lot. The other thing that people get concerned about is, like you were going to talk about, is your heirs. What happens when you die?
Right.
Well, the balance on that reverse mortgage is never going to be due to your heirs over and above what the value of the property is.
Okay.
So that was also an issue before.
Where people were actually getting loans that it would be more than the value of the property.
That when you passed away, that the balance of that loan, because of the accrued interest, was more than what the property was worth. Now your heirs are not obligated to pay that difference.
Okay.
So it's a non-recourse loan.
Okay. So like when we start again, we'll go back to that $600,000 house. And let's say I took a lump chunk of $300,000. And then over time, as time goes by, obviously I'm paying that $300,000 balance is getting bigger. Potentially, ideally, the balance of my house, the $600,000, is getting higher because prices are going up.
Right.
But if we've seen it in the past where, let's say, prices did come down and the balance goes up and those numbers crisscross, now all of a sudden they owe $450,000, the house is not worth $450,000, they're never going to be
upside down.
Okay.
The lender takes that risk.
And how often does the lender actually pay attention? Are they doing appraisals every few years, or how are they?
No,
one's
the money's
watching that.
and it's not until you actually have what we call a maturity event that it becomes the point where you either have to pay off the loan or sell the property. And that maturity event is when the last borrower is no longer occupying or has deceased the property. That's when something needs to take place.
Okay.
In that case that you were talking about, if you do in fact owe more, then because it's a non-recourse loan, then the heirs would sell the property, and it would just be a break even.
Right. The proceeds would just go to the lender or whoever's servicing that.
Or negative, where the lender would just absorb whatever the overage was.
Gotcha.
Yeah.
Gotcha. So these are very useful products for people out there. They're not as common as some of others because obviously, reverse mortgages or DSCR loans are not the typical things that we hear people talking about. So if you're looking for information about any kind of loans like this, by all means, reach out to us so that we can get you with a professional, because I've heard horror stories on some of these, especially the reverse mortgages, where I end up meeting a couple that got a reverse mortgage and I don't know who did it or how they understood it. And I've seen some balances go from, I own a home at $600,000 to a giant balance relatively quickly, and they have no idea where the money went. So just be careful with those. We can put you in touch with Kathy. And if you're looking for more information about this stuff, by all means, subscribe to the channel, follow us. We'll get you all kinds of great information about loans and having a great lender here locally. And regardless if you're watching these videos and you're from anywhere in the country, we can put you in touch with lenders anywhere in this country to help you with these things. So we appreciate you watching, and we'll see you on the next video.